Oil prices jumped suddenly and global markets reacted instantly. Stocks moved, currencies shifted, bond yields responded, all from one commodity. Today, I will explain why oil still controls the global economy, what caused this sudden spike, and why central banks and investors take oil moves more seriously than almost anything else. Many people think oil is the old economy. It is not. Oil will decide your inflation, interest rate, government deficit, currency stability, and corporate profits. That's why when the oil moves suddenly, markets don't wait for confirmation, they react first and ask questions later. So, what caused the sudden oil spike? The recent jump in oil prices was driven by a combination of supply fear and geopolitical risk. First, supply concerns. So, any disruption or even the threat of disruption tightens the global supply instantly. Second, geopolitical signals. When major powers take action that could affect the oil trade routes or exports, market price the risk immediately. Third, positioning. Many traders were positioned for stable or lower oil prices. When prices moved up suddenly, short positions were forced to exit, accelerating the spike. Oil does not move slowly, it jumps. So, why did the market reacted so fast? Here is the key reason markets react instantly to oil. So, oil feeds directly into inflation. Higher oil price mean higher transportation cost that leads to higher manufacturing cost. Now that leads to higher food prices and ultimately higher inflation. And higher inflation means central banks delay the rate cuts or even tighten the policy. So when the oil spikes, markets immediately reprice interest rate expectations, currency outlooks, and equity valuation. So why does central bank fear oil more than stock market? Stock markets can fall and recover, but oil-driven inflation is much harder to control. That is why central banks watch the oil prices in a very obsessive manner. A sustained oil spike can undo months of inflation control. So, even a short term jump in oil sends the warning signals across the financial system. So, what does this mean for India and the investors? For India, oil prices matter even more. India imports most of its crude oil. Now, higher oil prices will mean pressure on the rupee, higher inflation, stress on the fiscal balances. For investors, energy producers benefit. Airlines and logistics face the pressure. FMCG margins get squeezed. Bond markets become cautious. So, oil does not just affect one sector, it affects the entire system. So, what happens next? So, will the oil continue rising? In short term, it seems that the volatility will remain high. In medium term, it depends on the global supply decisions and geopolitics. In long term, oil will stay a powerful inflation signal even in a green energy world. Markets don't fear oil because it is expensive, they fear oil because it is unpredictable. Now, if you want to understand markets from top to down, calmly and clearly, subscribe to the channel. And if you want to see how RBI decisions and oil prices collide to shape inflation, watch this next. Thank you.